fiscalité, est-ce que vous préférez avoir vos instructions en français ou en anglais?
Oui.
Ok, on va y aller en français. Chaque équipe dispose de 20 minutes afin de présenter son cas au juge. J'afficherai un carton pour indiquer les 10, les 5 et les 2 dernières minutes ainsi que les 30 dernières secondes de la présentation. Lors des 10 dernières secondes du discours, j'indiquerai à l'aide de mes 2 mains le nombre de secondes restantes. Si vous n'avez pas terminé votre présentation après 20 minutes, elle se verra arrêtée afin de passer à la période de questions. Une période de questions d'une durée maximale de 5 minutes est allouée au jury à la fin de la présentation. Je tiens à rappeler au jury qu'il est obligatoire de poser au moins une question lors de cette période. Veuillez noter que vous ne pouvez en aucun cas dévoiler le nom ou encore la provenance de votre université, à risque d'être disqualifié. J'aimerais demander au public s'il vous plaît d'éteindre toutes leurs sonneries de téléphone cellulaire. Je vais maintenant laisser les juges se présenter et ensuite vous pouvez débuter votre présentation.
Bonjour, je m'appelle Marie-Ève Girard, je suis responsable de dossier en certification chez Raymond Chabot Grant Thornton et je suis candidate à l'exercice de la profession CPA.
Bonjour, Olivier Levesque, je suis fiscaliste chez Raymond Chabot Grant Thornton et je travaille en fiscalité canadienne et américaine.
Bonjour, Guillaume Raté de chez Mallette, je suis CPA et fiscaliste, je travaille en réorganisation corporative.
Bonjour, Éric Boissonneau, je suis associé chez Mallette, directeur de la fiscalité ici au Saguenay-Lac-Saint-Jean et pour la province. Bienvenue, bonne chance, vous pouvez débuter.
A tax return is like a book. It tells a story. Today we will tell you the story of Winflow Inc. Ladies and gentlemen, good afternoon. My name is Catherine. These are my colleagues Sanjeev and Adamo, and we are CAS Tax Services. So our mandate today was to advise your client, Christian Dallaire, on the tax concerns he has about his family and his company, Winflow Inc. So there are a few key considerations to look over before we start. So he mentioned that his son, Jean-Gabriel, will be attending Harvard University next year, and he wants to provide him with the money to pay for his tuition of about approximately $200,000. He is also a frequent visitor to the United States and is planning on relocating to Seattle to be closer to his other company, the Haas F1 team. And thirdly, he would like to have access to additional cash for retirement purposes. So here's the current situation. So Christian owns 100% of the J shares in his company, Winflow Inc. There's also his trust that owns 100% of the A shares. And the beneficiaries of the trust are Christian Dallaire, his spouse, and his 3 children. He also owns 9% in another company, Haas F1 team, with Michael Lord, who owns 91%. Because Christian only owns 9% of this company, both companies, Winflow and Haas team, are not connected, nor are they affiliated. So here's the agenda for today. So first of all, we'll go over the residency status, and then through the discretionary trust of the family, through corporate tax considerations, and finally through personal tax considerations. So first of all, for residency status, Christian has been visiting Florida during the past year for 5 consecutive months. So there are 3 scenarios that could be possible for this situation. He could either be a sojourner, a part-year resident, or a non-resident. So first of all, for the sojourner, this happens when an individual goes back and forth between Canada and another country. Total days outside of Canada have to be more than 183 days. He would still be considered a Canadian resident, and he would pay taxes on his worldwide income. For part-year resident is when an individual departs from Canada before year end. He becomes non-resident in the later of when he leaves Canada, his wife and kids leave Canada, or residency is obtained in another country. He would be taxed on a worldwide income for part of that year that he's gone, and tax credits would be prorated. The final scenario would be he could be a non-resident. So this happens when primary and secondary ties are severed. The same conditions apply for when he becomes a non-resident, and he would only be required to pay taxes on Canadian income in Canada. So for this situation, because he only spent a total of 150 days for the year outside of Canada, we think that he is a sojourner, and he will pay taxes on his worldwide income. For the corporation, a corporation is deemed to be a Canadian resident when it was incorporated after April 26, 1967. If it was incorporated before that, its operations must have continued to go on in Canada for it to be considered a Canadian resident. In this case, Winflow Inc.'s operations are in Canada, so it is considered a Canadian resident, and it will be taxed on its worldwide income. So for the discretionary trust, so as mentioned earlier, there is a discretionary trust in the family. So the beneficiaries are André, Mrs. Dalaire's spouse, Christian, and his two other children, Jean and Nathalie. The trustees are Christian and his friend Bernard Bolduc, and the settlor is Sarah Leroux, the actuary. So the implication of this trust, because Christian is a beneficiary and also a trustee, this could be a conflict of interest. So if possible, we would recommend that he find maybe another trustee. For the income, all the income flows through to the beneficiaries and are taxed on a personal level. Only dividends and capital gains retain their income qualities. The rest is considered to be property income. The trust has a December 31st year end. There is the dispositions of the assets after 21 years. So the trust will also be for his grandchildren, so it's very important for him to make sure that he disposes of the assets before the 21-year end. Also, if it is the case, if they dispose of shares, all beneficiaries could use their lifetime capital gains deduction, and it's very important to consider that dividends to minors, so to Natalie, Jean Gabriel, and André, will trigger kitty tax, so they will be taxed at 33%. I'll pass it on to Sandeep for corporate tax considerations.
Thank you, Catherine. So our client, Mr. Dallaire, we want to give $200,000 to his son because he's going to Harvard to get educated career. So we want to see how can we give him $200,000 and have least tax payable. So first option is holding company, because our client has investment in his company. We can open up a holding company and transfer those investment to that holding company. And we will give 49% of the shares to the children, and 51% of the shares will be given to Mr. Christian. He will retain the control of company, and the PUC and ACB to the son will be $1. PUC and ACB to the Mr. Dallaire is going to be $750,000. But something that we need to keep in mind is we are just transferring the investments. So the holding company would be considered a specified investment business. So this will be taxed at non-favorable rate. However, if there is more than 5 full-time employees, it can be considered ABI, and we will be getting favorable tax rates. So, next one. We also wanted to see how much tax is payable to the corporation. You have given us the taxable income to the corporation is about $5.6 million. We took a base rate of 38%. And federal abatement of 10%. We assume that all the income is generated in Canada, and you qualify for all the 10% of federal abatement, and GRR of 13%. Overall, your taxes payable is going to be $834,000. The company does not qualify for small business deduction because, according to IDA, you have to be CCPC and your working capital has to be below $50 million. However, currently your working capital is above $15 million, so you do not qualify for that small business deduction. Next up, we wanted to look at tax account balances. Currently, company had $50 million in capital dividend accounts, $50,000 in capital dividend accounts. GRIP was $850,000. In year 2016, there was a wholly owned subsidiary that was wind up in the corporation, and their GRIP will flow through the parent company, and it will increase the GRIP by $450,000. So ending GRIP will be $1.3 million. Next up, we calculated dividend refund to be $116,000. You're probably wondering how we came up with this number. Because we are going to be paying $300,000 in dividends. The way we calculate dividend refund is it's lesser of RDTOH or 2/3 of dividend paid to the taxable dividend paid to the shareholders. Now we also wanted to discuss capital dividend account, how we calculate that. It's 50% of the non-taxable capital gain, any proceeds from life insurance, and any CDA that we pay out, it's going to reduce the capital dividend account. We will discuss this will be reduced because we're going to be also paying CDA. GRIP is calculated as 72% of taxable income less any aggregate investment income, any income that qualifies for SBD, and you add beginning GRIP to that, it's going to give us ending GRIP balance. Next, we wanted to talk about personal tax considerations, and Adam will go through them.
Thank you, Sandeep. So, personal tax considerations is one of the main focuses for Mr. Christian Dara. So, we're going to go over all the situations. First of all, he wanted to sell his Miami residence in the States. So, how exactly would happen? There would be a capital gain on this because you are selling the residence. So if we look at the Miami residence alone, the ACV was roughly $3 million. The fair market value, $4.25 million, which gave a capital gain of $1.25 million. Years owned, 8 total years since 2010. So capital gains per year was $156,000. Now, what we could do is eliminate this capital gain through the principal residence exemption. You're allowed to use it, so he would have used this to eliminate the whole $1.25 million from his income taxes. If he would have liked also, you could have also sold the Roosevelt residence. So how that would have worked, ACV $750,000, fair market value roughly $1.35, considering his neighbor's fair market value, how much he was able to sell the home for. Capital gain of roughly $600,000. Years owned, 33 years. Capital gain per year, $18,181. So you might be asking, well, why did we choose one over the other? It's because the capital gain per year is much higher for the Miami residence. However, if you were to sell the Roosevelt residence, you'd be able to claim a principal residency exemption for this one as well, because the 33 minus the 8 years still gives you 26 years to be able to use, plus the 1 extra year the CRA actually gives you. So you could actually eliminate a good portion, roughly 75% of this capital gain as well. So Christian will elect the Miami residence in his principal gain exemption for the 8 years owned and eliminate all taxable capital gain of $625,000 on his personal T1. So a little bit about his personal income taxes T1. How much is he actually going to pay for the year? Super important. Nobody wants to pay that much to the government, obviously. So if you look at Section 3A, he had mentioned that he had employment income of roughly $200,000. Eligible dividends, which we paid out from the corporation. As Sandeep mentioned, we had a GRIP account, which is allowed to pay out eligible dividends to the company shareholders. This is a preferred type of dividend. Eligible dividends have a higher gross up, but a higher dividend tax credit, which reduces your taxes more later on. So the $300,000 based on the shares that he owned, 10 cents each came out to $300,000 times your gross up to 38%, came out to $414,000. So net income for tax purposes, very high, $614,000. You might be wondering, oh my God, we're going to pay a lot of tax today. But that is not the case. So RSP reduction, $25,000, which is the greater of the 18% annual on your earned income, or the maximum of $25,000. Because he doesn't make over $200,000 earned income, he'd be at the $25,000 maximum annual limit. So taxable income will come to roughly $590,000. Taxes payable, roughly 30%, total of $175,000. But if you reduce the tax payable by the non-refundable credits, which is the basic, the spousal, considering the spouse does not have any income, as well as employment, CPP, and EI, and the dividend tax credit on the eligible dividends of $82,000, his taxes payable will be reduced to $88,000. Now, that's a 15% decrease in taxes payable. It is a huge savings, and we're glad to see that. So if another thing that could be mentioned later on, when Christian's son Jean-Gabriel does go to the States and paying the really high tuition fees, he can actually claim a portion of his tuition fees in his taxes. So what do we mean by this? If he pays out $200,000, 15% of qualified tuition fees can be allocated to the son, but the son can transfer $5,000 maximum to the father. So he'd be able to claim another $5,000 off his taxes for the next year. And another thing to consider is that Christian will have to pay installments for the year 2018. Why do we say that? Because he has over $3,000 for tax payable for the current year. So it is quite a lot. If the CRA would have liked to do provision, they would probably come to the same amount, or just over the $200,000, they would still have a provision. So he'd have to pay every 3 months, March 15th, June 15th, September 15th, and December 15th. So, excess funds needed. Mr. Dada would have liked to have some excess funds considering retirement, the tuition, as well as his wife is a little bit sick and unsure about her circumstances. So we're going to go over a few options. So option number one, you could always declare a bonus. This is a taxable type of revenue, so we don't actually consider this as one of the best, but you can do it. You're an employee, you can consider yourself to have a bonus. You could receive dividends from Windflow. The optimal dividends would have received the $50,000 from the CDA account. Non-taxable to Mr. Dalla. He could use that in the future. He can invest it. He can do many things with it. Non-eligible dividends, if we would have taken the normal route for a private corporation, would have been 17% gross up, 21/29 dividend tax credit. It is not as preferred as the eligible dividends, as we saw the 38% gross up, but the 6/11 DTC. However, it is still a good way of receiving funds from a corporation. Another two things that we actually liked the most was the shareholder loan to Windflow that you had of roughly $1.25 million. This is actually a tax-free sort of money you can receive back through the corporation. Why? It's because you already taxed on that money before. You will not be taxed on it a second time. So $1.25 million received back tax-free. And then thirdly, you could actually remove cash out of the corporation, and what happened, it was decrease your paid-up capital in the corporation. So the $5 million of paid-up capital can actually be received tax-free. All happens is that it reduces your paid-up capital in the corporation. It will have consequences later on when you sell it. Another thing to be careful of, you're thinking you have RSPs, how can I use those? Please wait about the RSPs. You cannot use them until 65 years old. If you withdraw any money from your RSP, you're taxed at a 50% right away. And you can only receive your RSPs at 65 years old, as I mentioned. And once you become 71 years old, there's another step you have to do. The RSPs have to be created into a RIF, have to go into a RIF. You have to also remember that as well, because there are penalties and consequences. So, can we do other things aside just receiving cash? Of course there is. There are certain types of benefits you can receive as an employee through the corporation to reduce your lifestyle expenses. So you'd save one way, and the corporation could have some deductions on a corporate level. So, number one, we always start with the non-taxable benefits. So what do they include? They include group health benefits, so your nice group health plans that you receive from your nice corporation, RPP contributions, your stock option benefits, home internet programs, as well as retirement and reemployment counseling services. These are the main 5. There are a few others. We enjoy these the best because the employees are not taxed on a personal level for these situations. Now, what about if you want to be taxed and still receive certain other benefits? The main ones are the vehicle benefit. So we noticed that he does have a vehicle. He probably pays a lot on expenses in terms of gas, maintenance. If the vehicle was owned or leased by the corporation, there are 2 different methods. So we'll go over the lease right now. The lease is $800 maximum deduction per month. And the company-owned car depends on how much you actually spent on the car. For the corporation, if it is under $30,000, it goes into class 10 at 30% rate. So that is your deduction, the amortization, or CCA as we call it. If it is more, it goes into class 10.1, maximum at 30%, so it would be the same as class 10, 30% CCA rate. There are employee benefits to this situation. If you'd like, you could go over it in the question period. And secondly, the corporation can actually pay the tuition for the son if they'd like to. However, the son will be taxed on this total amount. So this is something we don't actually recommend because $200,000 on his son's taxes is quite a bit. However, if it was for school purposes were for work to help him his education and his future work purpose, he would not be taxed on it. So that would be okay. So, in conclusion.
So to conclude today, we advise your client, Christian Dallaire, on the tax concerns he has about his family and his company, Windflow. So for his son, Jean-Gabriel, we advised that he use the loan to pay the cash of $200,000. He is also a frequent visitor of the United States, and he will be relocating in Seattle. Therefore, we advised him to have the capital gain exempt on the house in Miami, and also that he is only a sojourner, so he is taxed on his world rent income and still a Canadian resident. And also, we provided solutions for additional cash and retirement with also the shareholder loan. So we thank you, and we open the floor for questions.
Got a question about the trust. talk to me about the trust. Can we do anything with it? We asked about can we give money to Jean Gabriel to pay for his tuition? So can we do it with the trust?
So for the trust, because he's a minor and is going to receive some sort of property income, you'd receive a kiddie tax. So you'd be taxed at 33%. If it is eligible dividends or non-eligible dividends, you can only claim the dividend tax credits for each. Everything else, you do not be able to use any credits.
Thank you.
Is there any tax credit that WinFlow can benefit? Is there any tax credit that WinFlow can benefit in this fiscal year?
Well, as we mentioned, they can use
We could also look into the shred credit they could have had. However, we weren't sure about the expenditures if they were in the right regions of Canada, so we weren't able to fully give you the answer for that at the moment.
For my security fee that I will pay Harvard for my son, can you give me some detail what I can put on that fee? Food or thing like that? You know where can I deduce in my income tax?
for the corporation.
No, for me.
Oh.
For my son, I would pay fee in Harvard. So do you think that, you said to me that I can have some deduction because I will have fee, but what is that fee? What I can use exactly?
Well, if you pay your son's tuition, if he pays his son's tuition for $200,000, he is eligible for a tuition tax credit that is transferable to him, and it's 15% of the total amount paid.
Okay. Okay. For the trust, you said that I have a kiddie tax, but you will not be. It will be an adult next year. Do you think that I will be able to use the trust next year?
Yes, so as 18 years old, you're not a minor anymore. You're allowed to receive income from the trust to Jean Gabriel. It would not cause any kiddie tax.
Okay.
I would like to know about the private lane of WinFlow. I use it for my own personal use, so I would like to know there's no tax impact about that. I don't think you talked to them about that. I would like to know.
We saw that last year the plane was used completely for corporation, but this year our client has been using for personal uses. 10 of those trips were for personal. We didn't know exactly how many trips were used in full year. We can prorate that, and it would be for personal use. It would not reduce our income, and it's not an expense to the corporation.
Okay, thanks.
Last year, we acquired shares in the House of One Team C Corp. Is there any consideration I have to take for my for WinFlow or Mr. Dallaire?
Yeah, so Mr. Dallaire owns only 9% of House of One Team, which is very cool, by the way. I like that. Basically, we looked at some situations as connected corporations, related corporations, affiliate corporations, and associate corporation. It did not fall into any of those. So there was nothing that really triggered any sort of allocation of a small business deduction or shred annual limits. So there were nothing wrong with that.
All right. Can you talk to me about the idea of a Christian to, let's say, sell for $1? The investment that Christian has personally.
Mm-hmm.
Can you talk to me about it?
What would you like to know about it?
Well,
Is it a good idea?
Is it a good idea for Christian to sell for $1? His investment
no, it is
to his
not.
son.
It's not a good idea because it would trigger gifting problems. You don't want any of that because then it would, because you are a non-arm's length transaction, it causes ITA 69 gift situations. If he does it for $1, you'd still pay tax on it at fair market value, and then the son would receive it at his cost base. So it would not be recommended.
And if we just give the investment to him with not selling.
Well, if you give it to him, it's still taxed at fair market value. So you just have to elect it at the right price. That's all.
Okay.
All right.
All right.
Thank you.
Thank you very much.